Joining me right now to talk about all of that is Andersen Capital Management Chief Investment Officer Peter Andersen. Also joining the conversation all morning long this morning is Fox Business's Dagan McDowell and Strategic Wealth Partners President and CEO Mark Tepper. Great to see everybody this morning. Thank you so much for being here. Peter, kicking things off with you, your reaction to the Fed minutes and what we learned, what you're expecting as a result of these rate hikes.
Well, you know, these minutes are backward looking, so they're not, I mean, even though they're projecting the future, Maria, I do think that they opened the door just a little bit with nuanced language that might give them some more flexibility. So let's assume that things stay the way they are now. Of course, I think they will continue to raise rates. But, you know, we are in such an uncertain period now, looking at this data daily. And I wouldn't be surprised if we started to see inflation ebb a little bit. And in that case, I'm hoping that they'll be adaptable enough that they might actually have to revise their thinking based on those minutes. I think that we are coming out of a period, I've said this before, where we have no map and they're trying to do the best they can, but we can't look at a playbook. This is all new data. And it is very, very challenging, isn't it, to go forward with this and map out a roadmap for even through September of this year.
Yeah, and they were very clear that we're going to have a 50 basis point hike in June, July, and then there was a debate. Some of them said yes, September as well. Others said at the Federal Reserve, well, we want to see where inflation is when September comes around. But Mark Tepper, jump in here because we're waiting for the GDP out this morning, and the GDP is expected to show a contraction of 1.3%. This is the second revision of the GDP, the second reading, rather. The first one was the first revision. This is the second reading. And we're looking at a contraction. We'll also get personal income and spending out tomorrow morning. Your thoughts on what you heard from the Fed, Mark?
Well, Maria, I mean, there's absolutely no question about it. Look, growth is slowing. Inflation's eating away at consumers and businesses. And I want to ask Peter a question. So the question is this. The story end of last year and kind of leading through the beginning of this year was all about yields were going up and therefore growth stocks and tech specifically got banged up as a result of that. But Peter, over the course of the last several weeks, you've seen yields come down meaningfully. So you'd expect a relief rally in growth stocks and tech stocks, yet the NASDAQ continues to make lower lows versus the S&P. Why isn't the NASDAQ, why isn't the tech getting any love? Tech sector getting any love? What do you make of that, Peter?
One of my favorite topics. Thank you for asking that. Well, I've always been a critic of the basic theory that when interest rates rise, growth stocks take it on the chin. You know, Mark, there have been many occasions, I've written them out myself, done the calculations showing future cash flows, discounting them back, and depending upon the assumptions you make, you can get any answer you want. So it's not that simple. Some people have said, I mean, we've heard this mantra over and over again now for at least a year. Rates go up, growth stocks go down. If you have growing cash flows that offset those rates, you can make that such that growth stocks will even beat value stocks. So I'm not at all surprised. In fact, I'm a little bit relieved that this might be breaking down right now because it's a much more complicated calculation and presentation to make than a simple one-liner that we've heard, as I said, for the past 12 months.
Yeah, I mean, you just wonder where the bottom is, given the fact that the NASDAQ is already down 30% year to date. We're seeing valuations way down from where they were just 6 months ago. And when you're talking about the Federal Reserve, Dagan, it's not just the rate hikes coming, right? It's the unwinding of that $9 trillion balance sheet that you talk about so much.
Right, which is just in the purest terms, the destruction of money. And that would suggest that all of these wildly overinflated assets, even with, say, a loss of 30% on the NASDAQ, have a lot more air to come out of the bubble. And this is anywhere and everywhere. And in terms of inflation, the Federal Reserve will still be under pressure to reduce that balance sheet and raise interest rates because of just what's happened with the price of diesel. Now, diesel hit a record high on the 18th of May, and it's come off that record high. But we need to remind people over and over again that anything that is transported by train, truck, ship, tractor, it uses diesel. And that filters through to any product and every product around the globe.
Yeah, that's a great
and then
point.
you talk about farming. Farm equipment, diesel engines power 2/3 of all farm equipment. 90% of farm product is carted to market using diesel. And 1/5 of the water in the United States is pumped via diesel. So how that doesn't continue to fuel broader inflation, it's not a guess, it's a certainty.
Yeah. And in fact, Peter, this is the only place that you really made some real money this year. If you were in energy, you're good. You're probably up on the year.
You would be, yes. And, one other thing I wanted to mention, Maria, is, the SNAP situation where they revise their outlook in such a short time. I think that is so symbolic of the way we are right now in markets. I mean, there's been so much new news that we can't really spend much time thinking about each individual situation, but let's just spend 30 seconds on Snap. The fact that they changed their outlook in such a short time is stunning to me, and I think it shows you that even the top CEOs of companies trying to get a picture of where we are, it's extremely difficult, in that they would go to the point of actually filing a revision saying that their outlook has changed in, what was it, 4 or 6 weeks. That's incredible.
Yeah, that was very significant, and it obviously moved all the social media stocks, right, Peter? Then there's Twitter. Elon Musk announced that he's going to increase the equity portion of his funding plan for Twitter. Now it includes $33.5 billion in equity. He will no longer rely on a margin loan backed by the Tesla shares. Tesla stock has traded down in all of this. The announcement sent Twitter up in the aftermarket last night, and the co-founder, Jack Dorsey, reportedly is stepping down from the board as well. Any thoughts on where we are on this Twitter acquisition from Elon Musk?
Plenty of thoughts. I don't think I have enough time here, but just a couple of things. Number one, the fact that he has talked about how many bots, fake accounts are in Twitter. Amazing that he's brought that up at this point.
Love it.
I think it could just be a negotiation tactic, but on further investigation, it is very difficult to count those number of bots. So, for instance, if you take 100 accounts and you do an algorithm to figure that out versus actually hand counting them, you get crazy differences. And so that could be just a negotiation tactic for him to bring down the price. But when you're talking with Elon Musk, there's all kinds of things that can come out of left field, and I do expect more surprises with him before we actually get to deciding whether or not the deal is going to close.
Yeah, no, I think he really exposed something important with that exercise of figuring out how many fake accounts there were, for sure. I love it. Peter, it's good to catch up with you as always. Thanks very much.
Okay. You're welcome.
All right, Peter Andersen joining us this morning.